Hi everyone, this is Jason Martin with AllGen Financial Advisors. Today is 6/16/2021. Wanted to give you a quick market update because we've been getting a lot of questions about inflation and what's going on with inflation, what are the ramifications of inflation, how does it affect my portfolio, and what we're doing about it. So I want to take a minute and give you some of my thoughts about this and what we're doing about it. So let's hop right in. So if you can see this next slide here, you will see a chart of the U.S. inflation rate. And this chart represents what the inflation rate is for the United States over the last 20 years. And as you can see, this purple line or inflation, really for that 20-year period, has been averaging about 2.5%. But you can see more recently, we've had a big spike up. And really, if you look at this chart, this was kind of the beginning of 2021. So we've gone from about 1.5% all the way up to almost 5%. And it's the highest point, just about the highest point in the last 20 years. The prior high point was in 2008. But so all that to say, inflation has spiked up a lot recently. And it's kind of been a perfect storm for inflation. You have a lot of things going on. You're coming out of a pandemic. And during that pandemic time frame, you had a lot of manufacturing facilities closed down, a lot of transportation issues of getting products and supply chain issues of having products. And it's just been taking a long time to get all different types of materials, whether they be chips, semiconductors, whether it be, lumber, windows. A lot of different things that it's been affecting in terms of supply chain. And so you have that happening along with now the economy starting to rebound. People are going back to work quickly. The amount of vaccinations that have been administered has gone up a lot. So economies are opening up. All good things on that front. And at the same time, you've had a lot of stimulus providing a lot of people cash, and sometimes providing people cash that still had a job the entire time, so they have extra cash. So you have people forced to stay at home for a long period of time. A lot of people wanting to do home renovation projects because they're forced to stay home. And then you have supply management or supply chain issues, and then you have a lot of cash for people wanting to buy things. So it's kind of been a perfect storm for inflation. And the real question is not if we're having inflation right now. Obviously, right now we are having inflation. But the next question to ask is how long will it last? And that's kind of the big unknown. If you listen to the Federal Reserve, a lot of economic experts, the buzzword these days is inflation right now is transitory. And what that means is it's basically temporary. So we're going to get a big spike and then it should taper off and come back down. And I think there you could definitely make the case for that as people go back to work, manufacturing facilities open back up at full capacity, supply chain management issues start to come back online. It will take some time to work through that, but I think for the most part, that will start to happen, which should decrease some of the inflationary pressure. Okay. On top of that, you have a dollar that's been weakening, and a lot of that's because we've been printing a lot of money and we've been sending a lot of stimulus checks. That will probably start to slow down, what they call taper over time. They'll stop printing as much money, and the stimulus checks will probably start to slow down as well. So I'm sorry to inform you that. No more checks. But either way, that should help inflation too. So we do think while inflation is high, and it may be high for a little bit of time, we do think it will taper off to a certain degree. So let me show you right here. This is a very interesting chart. And the funny thing is, we showed you this chart in our January webinar. And it's funny how quickly things change because at that point in time, I looked at these two boxes down here below, and let me explain this before I jump in the different boxes. But basically what this chart is and what we're looking at here is the different types of inflationary environments. Okay, so we have a quadrant, basically 4 different boxes here. On the bottom left, it's low and rising inflation, and this goes back to 1988. So it goes from 1988 all the way through 2020. But times of low and rising inflation, And the median inflation is 2.5% here. So if it was low, it was below 2.5%, as measured by the CPI, which is a measurement of inflation. And so then you have low and falling inflation, you have high and rising inflation, and high and falling inflation. So these are the different types of environments with inflation. Now, at the beginning of the year, we thought we were in this low and rising inflation. And so we had mentioned at that time that what we had been doing in the portfolio is we owned quite a bit of gold. We had added gold actually back in 2019, but started adding more to it in 2020 after the pandemic. And that we had a little bit of commodities. We had been adding to emerging markets and basically positioning the portfolio for a rising inflationary environment. And that thought process worked out. We do have a rising inflationary environment, but now we're no longer in this quadrant. Now we're in this quadrant over here that is high and rising inflation. And so as you can see here, and just so you know, I didn't thoroughly explain this, but these are all the different asset classes, each one of these bars, blue being fixed income, green being stocks or equities, and then the gray portion here being alternatives, like REITs, which stands for Real Estate Investment Trust, commodities, and gold. So it looks at how all of these different areas perform in inflationary environments. And so, the good news is no matter which one of these environments you look at, just take, for example, equities. So let's think about stocks. In a low and rising inflation rate, they were up 11%. In a high and rising inflation rate, they were up 13%. In a high and falling inflation rate, they were up 15% on average. And then in a low and falling inflation rate, they're up 12%. That's pretty good in every single environment. So one of my points that I wanted to make is rising inflation on its own is not necessarily a bad thing for stocks. In fact, in a lot of cases, as you can see by these charts, stocks do well, equities do well in a rising inflationary environment. The problem what could happen is we could go into a rising inflation and a slowing economy. And so if you remember back in the 70s, there was a term called stagflation. That was bad for stocks. But I don't believe we're in that environment. We're not in that environment right now. The economy has really taken off. And even though we have rising inflation, we also have a strengthening economy. So I'm not concerned about that now. If we look forward a year, 2 years, maybe we'll start to keep an eye out on that. I mean, we'll always be keeping an eye out on that, but maybe it's more likely that could come down the road. But as of now, the economy is strengthening along with inflation. So that in itself is not bad for equities. Now, as your money manager and as a portfolio manager, what we're trying to do is we're trying to make sure that we position ourselves in an area that should, or in the different types of asset classes that should do well in an inflationary environment and in the inflationary environment that we're in right now, which is high and rising inflation. So in that scenario, emerging market equities have performed the best. We've been positioning in emerging market equities and raising our percentage in that area since the beginning of the year. And so that is an area that we are already positioned for. We had actually shifted, interestingly, and the last quarterly rebalance that we did back in late March, early April, we reduced some of our gold and we added a commodity basket, basically a fund that owns a bunch of different types of commodities. So not just gold, but other things like the different types of metals, the different types of energy sources like oil, natural gas, heating oil, and even agricultural types of things like wheat and sugar and soybeans and those types of things. So and corn. And so, we believe commodities and historically those types of commodities have done better in a rising inflationary environment, but also an improving economy, which is what we're in right now. So we shift a little bit out of gold, more into that, fund of a bunch of different types of commodities, and we still have a good portion in equities. So I want to put you guys at ease that to just because we have inflation doesn't mean it's bad for stocks. Okay. Now, what we need to really be conscious of is where we're going from here with inflation, because if we go from Right now, we're positioned for inflation, and we've been positioned for inflation. Your portfolio or our clients' portfolios have been positioned for inflation for quite some time. And so we're prepared for that. If inflation continues to happen, we believe we have our portfolios positioned for that environment. But what we want to be sure of is what if inflation is transitory? What if it's only temporary? What if inflation starts to slow? And if that's the case, I put an orange box around this one. But this one shows you that if inflation was high and falling, which is a possibility. Well, good news is what we've been increasing into, especially on the emerging market side, this what's called EM equity, still continues to do well, and stocks continue to do well. What we need to be conscious of, if that's the case, possibly we then need to reduce some of our commodities in gold, because that underperforms when inflation is high and starting to fall. And so that's really what we're looking at over the next few months to see what happens. And just wanted to kind of bring everyone up to speed as to our thoughts on inflation, give you kind of some perspective and how we're prepared for it. So I hope this helps. Hope this puts you at ease. And if you have any questions, feel free to reach out to us.